Okay, everyone. So I just want to tilt you guys about consumer sentiment. The data came out today. The stock markets are moving higher, and I just want to show you why consumers are so important to the stock market. Because spending, if consumers are confident, drives the earnings of companies, which drive the stock markets. Okay, and today's data really pointed towards growth in GDP, and that means as inflation's falling and growth remains good, then that opens the pathway to lower interest rates by the Federal Reserve, which is what it says here. S&P 500 nears a record high on lower interest rate expectations. So we're going to look at the NASDAQ and we're going to look at the S&P 500, which are now breaking up to new all-time highs. And this is really important to understand the relationship between consumers and stock markets. Okay, so today's data came out and you can see that when we're looking at the data from today, consumer sentiment, which basically just tracks the confidence of consumers, came out in the United States at a reading of 78.8, and more importantly, inflation expectations dropped closer towards 2%. So I'm going to break down why this happens and then why the markets are now betting, for an example, on these aggressive rate cuts by the Federal Reserve, which is on this spreadsheet, which I update to understand where interest rates are going. Okay, so what we need to pay attention to is what is the historical performance of consumer sentiment and the stock markets. Okay, so all you have to do is bear in mind how confident are consumers, okay, and how will that affect their spending. So if consumers are confident, they're going to spend more. If consumers are less confident, they're going to tighten their spending, and that's going to mean that earnings for companies are either going to grow when they're confident or contract when consumers are not so confident. Hence why, as consumer sentiment comes out positive, stock markets go up throughout history. So we can look at the latest reading, we can actually compare it to levels of GDP. So a reading today of 78.8 is actually equal to GDP growth in America of around 1.6%. The long-term average of GDP growth in America is 3%. Okay, and we came from a negative reading in 2023. So if I show you this 2023 spreadsheet where we track the US economy, you can see that in the United States, consumer sentiment throughout last year was tracking negative growth. Okay, now it's turned positive. So consumers are confident about their future and it's tracking towards positive growth. Now look throughout history, when consumer sentiment goes up, you can see GDP growth increases. When consumer sentiment starts to decline, you can see GDP growth in percentage terms highlighted in red starts to decline. And as the confidence of consumers, which is highlighted in this shaded color here, starts to grow again, look at GDP growth starting to expand. And you can see there's a very strong correlation between the performance of GDP growth and the confidence of consumers. Now that's really important because if I now compare this to the S&P 500, now look how beautiful the returns are. You can see here, when we've got this highlighted, the yellow line, this is again consumer confidence getting higher and more positive, so going up and up and up, and you can see the S&P yearly returns follows. Can you see the correlation between how they move with each other? S&P percentage terms per year, 10%, 20%, is equal when you're getting growth of 20% in the stock market. Look where consumer confidence is, it's high. And then when the stock market is down 20%, why is it down 20%? Because the confidence of consumers are down as well. And look, you can see this beautiful correlation between the two. And look what's happened recently. Consumer confidence is getting stronger and stronger and stronger. And no surprise, the stock market is pushing higher and higher. Now, secondly, okay, the reason the markets are betting on lower interest rates is because they're betting on inflation to fall in the United States, and the consumers are betting on lower inflation. So when we saw today consumer confidence, expectations for inflation, which I just showed you over here, you can see in 1 year, they're expecting inflation to go from 3.1%, which was their last expectation in December for the year ahead. Now it's falling to 2.9. That basically means inflation is getting closer to the central bank's 2% target. Okay, that's what consumers are expecting over a 1 year period. Over the next 5 years, they're expecting inflation to be at 2.8%. Over 10 years, when you look at the market's expectations, at 2.38%. So inflation is getting closer to the 2% target that the central bank has set as their mandate. Now that basically means consumers are less likely to demand higher wages because inflation is falling towards to the central bank's target, and that means that businesses are less likely to raise prices on the shop floor to offset the cost of having to pay people more wages. That is why this is so important, and that's what's driving the market's expectation of these rate cuts, and it's rate cuts that drive the stock markets. Okay, because if I show you right here, if I take out this chart and I bring the US government 10-year bond yield, you can see the performance of the stock market is based on where the bond yield is going on a 10-year government bond, and the 10-year government bond interest rate is going where the markets are expecting interest rates to go. So let's have a look. When the central bank in the United States started to raise interest rates around March 2022, around this period, look, that is when the stock market started to decline as the interest rates were going up, okay? And then in October 2022, we saw the bond market start to go lower in terms of the yield in a 10-year bond. And the reason it was going lower because the markets were expecting rate cuts. And what happened straight away? The stock markets took off. And then what happened? Notice how the stock markets then started to drop. Why? Because the bond yield took off again. And these bond yield moves are all based on the expectation of interest rates. And then again, look what happened here. Now the markets are betting on rate cuts again. Boom, stock market takes off at exactly the same time, okay? And at this moment in time, we've had a little bounce higher in the bond yield, okay? But because markets are still betting on rate cuts, that's why the stock market hasn't fallen, because these rate cut expectations are driving the stock markets. Now, all you need to understand, why does a 10-year bond push the stock markets in a certain direction? Because interest rates on mortgages, credit cards, car loans, student debt, that's all pegged above the 10-year government bond yield. So as this bond yield falls, everyone's interest payments go down. So they have more money to spend. That's why the stock market goes up. When the bond yield goes higher, it means people have less money to spend because their interest payments go up on all their outstanding debts. That's the important correlation to watch, okay? So consumer confidence is very important. And it's really important to track the macroeconomic data so you can fully understand what's pushing the markets in today's trading session. And it's really important to get these spreadsheets so you can understand what the hell is going on. Otherwise, it's very difficult to try to trade the market. So you can see last year's spreadsheet, we track all the data and it really helps us. So if consumers are getting more confident and inflation is falling, then that means interest rate cuts are coming and the stock markets are likely to keep rising in 2024. So if you'd like to come and join me in the VIP trading team to understand how to trade the market, just send us a message on a 30-day trial. And hopefully, guys, I'll be trading with you soon.